All right, let's dive in. Today, we're tackling a brand new investment category that's got a lot of seasoned investors talking: Specialized Investment Funds, or SIFs for short. So what exactly are they? And more importantly, are they right for you? Let's find out.
So, let me ask you something. Does this feel familiar? You've been investing for a while, right? You're kind of past the basics of simple mutual funds. But then you look at something like portfolio management services, PMS, and it just feels a bit much. Maybe too complex, definitely expensive, and frankly, a little intimidating. If that's you, trust me, you are not alone. A lot of investors get stuck right there.
It helps to think about it like you're buying a car. A regular mutual fund, that's your trusty family sedan. It's super safe, heavily regulated, and it gets you where you need to go. No fuss. PMS, on the other hand, well, that's like a Formula One race car. It's incredibly powerful, totally customizable, but wow, the price tag is high, and it's a whole different level of risk. For years, there's been this huge gap between the sedan and the race car, a spot just waiting for a perfect sports sedan.
And that brings us right to our first section, the investor's crossroads. This is exactly that point, that gap, where you're looking for something with a bit more horsepower, a bit more flexibility, but you still want the safety and transparency you're used to.
Which, of course, leads us to the solution. Section 2, Meet the SIF. This is it. This is the sports sedan of the investment world, designed to give you more power than a standard fund, but without the extreme commitment of a high-end service.
Okay, so what is an SIF officially? Well, SEBI, our market regulator, rolled out this new framework in 2024-25. At its heart, it's still a mutual fund, but it's a special kind. It's built specifically for more experienced investors, and it gives fund managers a lot more freedom to use dynamic, strategy-driven approaches, things they just can't do in a regular plain vanilla fund.
And this is probably the most important thing to get. SIFs sit in this really unique sweet spot. They give you way more strategic freedom than a normal mutual fund, but they're still more regulated and transparent than a PMS. It's that balancing act, that best of both worlds position, that's their main selling point.
All right, so in Section 3, let's really put this to the test. We're going to put all three options, mutual funds, SIFs, and PMS, side by side, and see how they stack up on the things that really matter to you as an investor.
Okay, first up, how easy is it to get started? With a standard mutual fund, you can often jump in with just 500 or maybe 5,000 rupees. Super accessible. It's designed for literally everyone, which is, fantastic.
But now, take a look at the SIF. That's a big jump, right? A minimum of 10 lakh rupees. And that number isn't just pulled out of thin air. It's a deliberate filter put in place by the regulator. They want to make sure that only serious, well-informed investors who understand and can handle a higher level of risk are playing in this space.
And then all the way at the top, you've got PMS. The minimum ticket size there is 50 lakh rupees. That puts it squarely in the high net worth territory. So you can see it really clearly now, right? The SIP carves out its niche perfectly, right in the middle of the road.
Now this table really pulls everything together. You can see SIFs offer more flexibility and strategy, but look, they keep that high level of regulation, just like a mutual fund. But the real game changer here? It's that transparency row. SIFs have to publish a daily net asset value, or NAV. That makes them way more transparent than a typical PMS. It's this unique balance of features that really makes them a whole new animal. Okay, so we get what they are. We see how they compare, but here's the real question. Is a SIF actually a good idea for you? Well, to figure that out, we have to take a really honest look at both the good and the bad. So, on the plus side, that strategy freedom, it's a huge deal. It means your fund manager can make big, concentrated bets on companies they really believe in. Or if they think the market's looking shaky, they can pull back and reduce their exposure in a way a normal equity fund just can't. It's basically a regulated, transparent alternative to PMS, but at a fifth of the entry cost. And all that flexibility could mean better protection when markets start to fall.
But, and you knew there was a but coming, right? That very same freedom creates more risk. A lot more. Those concentrated bets can go wrong, and that can lead to some pretty wild swings in value. And since this is a brand new category, there's no long track record to look back on. You also have to think about liquidity. Some SIFs might have hefty exit loads or limit when you can pull your money out. Let's be crystal clear. This is not for beginners, and it's definitely not for anyone who gets nervous and sells when the market dips.
Which brings us to probably the most important question of this entire explainer. How do you know if an SIF is a good fit for your portfolio.
Here's a quick little checklist you can run through. First, is your overall portfolio already a decent size? Let's say over 25 lakh rupees. Second, and this is crucial, do you already have your core investments, your basic equity and hybrid funds solidly in place? Third, are you okay with volatility? I mean, really okay with it in the short to medium term. And finally, do you actually understand and want these kinds of different, more complex strategies? If you can't say a big yes to all four of those, an SIF probably isn't for you, at least not right now.
Okay, I'm just going to say this as plainly as I can, because it's the single most important takeaway, especially for newer investors. An SIF should absolutely not be your first mutual fund investment, ever. It's an advanced tool for an established portfolio.
And that leads us perfectly into our final section, and honestly, the most important rule for using SIFs the right way, the core versus satellite rule.
So here's the golden rule, summed up in one sentence. An SIF is a satellite allocation, not a core one. What does that mean? It means it is not supposed to be the main part of your investment strategy. Think of it as a smaller planet, a satellite that orbits a much bigger, much more stable core.
Your core should be the vast majority of your money. We're talking 80, maybe 90% invested in things like index funds or balanced funds. Solid, steady stuff. The SIF fits into that much smaller 10 to 20% satellite slice of the pie. That's where you can take on more specific, targeted risks to try and get some extra returns.
And really, that's the question I want to leave you with today. Now that you know what SIFs are, who they're for, and how to think about them, is it time to add a satellite to your own financial universe? Have you built a core that's strong enough to start exploring some new orbits? Something to think about. Thanks for joining me for this explainer.